Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I am going to be your host for the next, we're going to say 23 minutes here on Options Guide TV. We're going to be a little short and sweet, kind of like the market this week, in that on Tuesday, the market will stop trading at 1 o'clock, and then on Wednesday, the markets will be closed for the holiday. So we do want to put on a trade this week, and I want to lean into the bearishness of the marketplace. Ever since the Fed has had their meeting and kind of hinted that the odds of a lot of rate cuts over the year are going to be lower, the actual Fed funds future, the Fed Watch tool over at the CME, is indicating that at their next meeting, they might not, they're looking to do nothing, just leave the market as it is. And there's only a 50-50 chance that they're going to cut rates on the next meeting after that. So the market has taken that to heart. And we had a volatile week last month. We finished up a little bit on Friday. We had a solid day on Friday. But the market overall for the week was down when looking at the S&P 500 index, and also the NASDAQ was down a smidge too. So overall, not a great week. Right now, we have the S&P 500 index trading down 858. And we have the VIX index just kind of hanging around that 19 level. So today what I want to do is I'm going to do something different in the SPX. I was thinking about doing an iron condor because of the reduced number of trading days this week. But I decided that I'm going to do a skip strike butterfly on the bears, on the bullish side of things. In other words, well, I said that wrong because we're ultimately going to be bearish on this trade. But we're going to, instead of doing a short call spread, we are going to set up a skip strike butterfly that is profitable if the market stays where it's at or goes lower. We're going to center it around the 1 standard deviation move, and it will expire this Friday. So I've done skip strikes. Usually we'll start with those on the bear side of things, and we'll make an adjustment to the trade. We're not going to be watching this one as closely because it is the holidays. And on Wednesday, there's obviously not an Options Guy TV show. So with that said, I'm going to put this one out there and just kind of leave it hanging and see where we end up on Friday. And I'll put out a tweet on Friday if it's within the range where we need to close the trade. But with that said, excuse me for a sec. And if I look at this now, here's the trade. Here's the setup. We have December 27th, and we got the S&P 500 index below 6,000. That's kind of sad that it made that move to the downside. But like I said, a little bit of a weak last week, or last couple of weeks, ever since the Fed has actually met. 59.25, we'll call it 59.26. We'll round up to that. And a 1 standard deviation move inside the Tradier Pro option chains. It highlights where that 1 standard deviation move is at, right around that 630 level. And if I look at the delta, it's moved a little bit on us right now. It's probably, I mean, we're looking at a 10 delta. So this is actually a better scenario, smaller chance of it actually happening and hitting that price. So in this level, if we're doing this trade, if this was a standard butterfly, we would buy the 620, 6,020. So I'm going to just shorten this. We buy the 620, sell 2 of the 630s, 6,030s, and buy the 640. And that would be our butterfly. And we're looking at the December 27th expiration, and we have 4 days until that expiration date. Now, by skipping the 640, we're embedding a short spread. And I'm just going to go from bid to bid here. But if we did the short spread where we sold the 640 and bought the 650, you'd look at bringing in about 80 cents on this trade. Well, right now it's saying 75 cents on this trade. And if that's the case, so you look at that, keep that in mind, because what we're doing ideally with this trade is we're taking that 80-cent net credit. Now, envision that you're selling the 640, buying the 650. But then you do the butterfly and you do the 620, 630, and then you buy the 640. So basically it wipes it out. So this is why I like to call this the skip strike butterfly as opposed to a broken wing, because we're skipping this strike, 640. And when we do that right here, we'll call it 80 cents. We then take that credit and we literally buy the butterfly. So the butterfly is going to be a lot cheaper. And if we do that, now that's the kind of the mechanics, the thought behind the trade. That if I sold this short call spread, I would bring in 80 cents. Now, if we look at the trade, we can set this up and our hedge is already in here because we have this butterfly that we're paying for, and we're bringing in 50. So let's call it 50 cents. Let's make it very simple. It's dancing around the 50 level. It's kind of moving a little bit now. Yeah, now it's back up to 53 on the midpoint, but it's a net credit to the account. Okay, so we have the same requirement of the short spread. We have a $1,000 requirement. We're going to bring in 80 cents. We're going to take a chunk of that 80 cents and we're going to buy a butterfly just in case the market starts going in our direction. So our concept is that we want to make this 40 cents, but we're not going to watch this as closely as we would a short call spread because we got a holiday week. So because of that, if the market starts drifting up towards Friday and it actually closes within this range between 6,020, I guess I should say it correctly, 6,020 and 6,030, well, heck, we actually hit a home run. We actually make the net credit, plus we can make another $1,000, the difference between the strikes. If it continues on up, we're fine until it gets to 640, but then our risk kicks in because that's where our short spread would be. And then from 640 on down, but it's actually a little bit less risk because we put this butterfly on, so we get a little bit of a benefit that this is a long call spread that would be profitable if the market goes above 630. Okay, so if we look at the profit and loss graph, I said it with words, but pictures are worth 1,000 words. Somebody said that once. So we're going to put this into the what if graph, what if calculator. And we'll scroll down here and zoom a little bit on here. Okay, so the market is this direction right here, 59.25. I think I can do one more. Oh, shoot. Okay. Let's try one more. There we go. 59.25. And as the market approaches expiration, what happens is the market is going to, it's kind of getting, the calculator's a little screwed up because of the days there aren't trading. That's obviously the reason why. But with that said, we have the 50 cent net credit to the account. It's saying 45 cents. So if the market stays where it's at or goes south, we're going to make, well, we have it at, well, I guess I'll put it at 45. We're going to make 45 cents on that trade. Anywhere from there all the way down. If the market drifts up towards our strike, which is the 6,020 strike, if it lands anywhere in here, we still make that 45 cents, that credit that we brought in. Now, if it gets here, this is where life gets interesting. So if by Friday it closes just above 6,020 and lands somewhere between here and 6,030, well, then it's a home run, right? Then we put it on for a net credit, and we're going to take it off for a net credit. And I said that correctly, by the way. So we're going to put on the skip strike butterfly, and it's possible that we could put the trade on for a net credit and take it off for a net credit. The maximum would be the width between these two strikes, 620 and 630, which is 10 points in that range. So if you ever see this thing trading and you can unwind it, like make this a sell, make that a buy, make that a sell, and you can unwind it for $2 to $3, you just want to get out of the trade. That means that we're going to get a huge rate of time decay. Obviously, Tuesday got a short day, Wednesday not a day. Then you got Thursday and Friday. This expires on the 27th. And we land somewhere in this range, we're fine. And then we're also fine if it blows through the strike. Now, my attitude always is on these skip strike butterflies is if it hits the short strike, you get out. You might be disappointed, like, oh man, I should have had this type of gain, or you might even be down a little bit. I just don't like the stock to run hard against me on these positions because you have a lot of risk from here to here. You're trying to make 45 cents on the trade. You would have made 80 cents, right? You were trying to make 80 cents if you did the short spread. But from here to here, you have this risk of the market going all the way up to 660.50, and from there on up, you can lose the $1,000 minus the net credit received. 45 cents is what we have here in our limit price. So that would be $1,000 minus $45, and that would be your max risk on this position going into that trade. Now, if they have any questions out there, just toss them up because I can't see I'm working with one screen today. Go ahead and just put them on the screen and I'll address them as they pop up. All right. Now, on Friday, we did set up a VIX trade, and the market hasn't gone anywhere, but I did want to review it because we have some time today. Like I said, a little bit of a shortened Options Guy TV. But on the VIX trade, the market is at 1865. On Friday, we were at 1886. So this really hasn't moved much whatsoever. But the trade that we put on, if you did not watch the show on Friday, is we're doing a longer term trade. I talked about in the VIX, I really only like to trade the normal monthlies. They're going to go out till January. I still think that the market will come to its senses and be a little bit bullish going into the end of the year. We got the quote unquote Santa Claus rally. The VIX wants to be at 15. That's where the VIX wants to be. Now, when we got the big downturn, we kind of missed this opportunity on Options Guy TV, but, the Fed spoke after we taped the show, and the market spiked. We had a big downturn, and we've had the biggest spike in the VIX in some time. So I definitely would have wanted to get short then, but that opportunity is gone. I still think it's being sticky here around that 19 level. I anticipate that it's going to go down towards the 15 level as we get into the new year. I'm going to buy the January 20th VIX. Look at that index. We're going to go and buy the 20 strike here. And then we sold the 1750 strike. So this is a bear put spread, otherwise known as a put debit spread. You can put it on right now for $1.86, and the maximum upside is the 250. The difference between the strikes minus the net debit that was paid for the trade. So as far as our upside is concerned, if we look at doing this trade, you take 250 minus that net debit of 186 at this point in time, and you come up with 64 cents on the trade. So the risk reward isn't awesome on the trade, but I do feel fairly confident that the market can drift down back towards the 15 level where it was before the Fed spoke and shocked the market a little bit. All right. Well, if there's any questions, please put them in the chat box and I'll try to address them. But if not, well, you have a very happy holidays. And we'll be doing a few educational pieces here on Options Guy TV. I'm going to put together a seminar based off one of my most popular seminars, actually, that I do, called The Top 10 Mistakes for Option Traders. And we're going to do 5 mistakes on one day and 5 mistakes on the next day. So I would look for that over the holidays. On this trade, I'll be tweeting out some on x.com. My profile's at Brian Overby. You might be watching Options Guy TV right now on x.com. We do stream live through there and also through YouTube and also through the Tradier hub, hub.tradier.com. So with all that said, I'll be looking at this trade over the week. I like this trade for this week. I expect volatility to kind of calm down a little bit. And I'll leave it at that. We'll be watching it and we'll be looking to close it on Friday. And one thing that's also nice is that if you're looking at the VIX index, if you're going back to the what if calculator and looking at the SPX index, is that if it does land within here, it's cash settled option contracts. So what ends up happening is you just get cash in your account where cash used to not be. And that's really quite simple. Or if it goes this way, then everything expires worthless and you just receive that net credit of 45 cents. If the market goes all the way up this way, that's where you got to be concerning. So if you're going to set an alert right here at the 640 strike. That's going to make you nervous. Also set one at the 630 strike, because if it gets to the 630 strike, you probably want to close it out anyways. Thanks for coming. We'll see you, I guess, in the new year is the next time we're going to be live here on Options Guy TV. And looking forward to 2025. I think the markets are going to be very interesting to trading vessel for that year. So thanks for stopping in, and we'll see you next year.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.